All right. Welcome to the final talk. My name is Yves. I'm actually the initiator of the SAP Python meetup group. And thanks so much to Jonas, Sebastian, and the company Native AI for hosting us here. It's really honorable from my point of view, particularly after the last 2 years. We all know what happened back then. And we all did it virtual, online, but now getting back in a room with a bunch of Python enthusiasts, that's basically, it's kind of wonderful, I would say, right? Yeah, my talk is about do-it-yourself quantitative stock market investing with Python. Why that? Yeah, because robo-advisors and wealth robots, however they're called these days, companies like Wealthfront, or in Germany you have a couple of them as well, like Scalable, they offer like automated investment. But for people like you guys who know a bit about programming, it's basically not that difficult to do it on your own. So my first question, who is investing in the markets? Whatever it means, stock markets, Forex, or whatnot. Oh, not too many. Do you use Python to do that? Or it's just like, do you use any of the robo-advisors that are out there? One, two, maybe a little bit of inspiration to try it for yourself. So my whole setup here, the whole resources, I've hosted in a gist. I will share the link later on. So it's more meant to be like a sandbox where you can play around a little bit. I have maybe a bit too much for the time that is allocated for the talk, but let's get started quickly. I want to jump more or less over the introduction. It's just for reference. A few words about data-driven finance. So how finance has changed basically, well, for example, since I did my PhD in math finance here at the university in 2000, a long time ago, right? And I want to show how you get your data to do what I'm going to show later on with regard to mean-variance portfolio theory. So one of the first things when you study finance that you encounter there, it dates back to the 50s, 1952, and then a pretty modern approach that has become really popular on a large scale with hedge funds, etc. And that's about risk allocation. Our company, Python for Finance, that's it. Everything is around that. So on tpq.io, you'll find the details. We also have a team in India which has built our trading platform. So what we are going through today is about investing. So picking things, investing in them, maybe change here and there. Algo trading, which is one of our main endeavors here, is a little bit different. So you do stuff intraday and you do maybe even on a sub-minute basis, right? So that's a little bit different. But we are going into the investment in the long term, maybe a retirement or whatever you want to say for space, right? Here my background, just for you as a reference. If you're interested in getting started with finance and you have a bit of Python background, this is the book that I recommend. It's my latest one, but it's the most introductory one I have written. So many people have asked me, don't you have anything which starts really from scratch? And this is basically explaining all the concepts that you need in the space if you want to use your Python skills in finance for investing. Or maybe something else, maybe for trading. And the most important relationship is the one between risk and return. And for everything that I'm going to show, even if you have never done anything in finance, the most important relationship is that whenever you want to achieve a higher return, you usually need to encounter more risk, right? You need to be willing to have something more risky in your portfolio if you want to increase your returns, right? And usually you can only decrease risk when you change something on the other side. All right, this is like the balance. If you don't know anything else about finance, that's at least a good starting point for what we are going through. That's my, I would say, best-selling book, if you can speak about that. It's not Harry Potter, right? But that's used these days around the world, and I'm pretty happy about that, not only by professionals, but also at universities, where people now indeed teach Python for finance. So I said I did my PhD in 2000. I started with Python very first small steps in 2005 only. So, but still, has been a long ride. Back then there was no pandas, no NumPy, no nothing. Right? When I was first attending EuroPython in 2011, this is around the time when Wes McKinney came out with pandas. So it was the first talk that I gave where I used pandas, so 2011, 2010, around that time, right? This is my background, actually, the quant finance side, not really of interest for what we are going to do. And these are my recent books. Many people come these days and attend our online courses for algo trading, for AI and finance. etc. pp. And my books, they get translated. Obviously, it's also interesting in other areas of the world, so Korea, Japan, etc. And I had a little bit of a smile actually, because usually I don't get that much feedback with regard to the translations, but the Japanese team, they are usually like, they discuss even things like the sequence of the imports, right? And I have my own philosophy about that. And I'm always explaining things, why I think that's the better way of doing it, because they have these typical Japanese people say, well, PEP 8 says X, Y, that. I say, yeah, but... Anyways, this I was like smiling. That how was it called? iSort, right? iSort, the tool. Maybe I should use that in the future. We have also a Discord community. There was a Discord community here at UDS mentioned. If you're somehow interested, want to get started in the community beyond what we have to offer, we have now a Discord server with many pros from around the world. And it's growing, and yeah, people are attending and discussing interesting stuff. So let me also quickly go through that so that we can get to the code. I can show you the code that you can later on use for yourself. We come from an area, obviously, where people read the news, right, printed and delivered to the doorsteps. But these days, I think most of us read, if at all, the news on the web, right? I do so. You can read it, of course, iPad, iPhone, whatever, on the screen. But the professionals, since decades, we can say, and by professionals, I mean the traders, the investors, the portfolio managers, the analysts, right? They look at the terminals, and whenever they're interested, let's say in Apple stock, they have like all the data that they want about the Apple stock on the screen. But these days, actually are also almost gone in terms of what moves the markets, and the market is moved these days by the tons and tons of data that are retrieved via APIs, right? When you think in terms of Apple, everybody knows Apple. Apple went public 1980, so it's some 40 plus years. You have roughly 250 trading days per year, times 10, 2,500, times 4, some 10,000 end of day closing prices for Apple over 40 years, right? And here you see the tick data for half an hour last year, November, and you see that there's like 41,000. So nobody wants to print it out, nobody wants to read it, but the machines these days, of course, are processing all of this like in real time, right? The big companies, they can't do anything else than getting their hands on all this data, also looking backwards in a historical sense, but in particular they need to crunch all these numbers in real time. And the machines, of course, they can do it not only for Apple, they can do it for the S&P 500 constituents and for much more. But this is really compared to the unstructured data, this tiny data, because roughly on a daily basis there are 1.5 million news articles that are coming out, and which the big data companies like here Refinitiv or Bloomberg or Dow Jones are crunching and are digesting, and you need to deal with data as well. It's not only numbers, it's also tons and tons of text, right, that needs to be digested in the financial markets. And that's, of course, a little bit different, of course. I would guess that here many people who are well versed in natural language processing. This can also be done, at least to some extent, comparable to the numbers in real time. But of course, the requirements here are quite a bit different, right? When you think in terms of what is behind a single headline, there could be tons of text. And when you then think that Apple has a new event, you can imagine what is happening with regard to Apple products around an Apple event, right? And when you want to keep up with that in real time, that's kind of like a different thing. Unfortunately, even for us, just having a MacBook with our wonderful tools, and I have only the most basic ones here. And usually in finance, we don't need that much more. There's usually nothing that sophisticated, right? That is required also for my code. I would say NumPy, Matplotlib, and Pandas are almost enough, right? If you want to do some machine learning, which I won't go into here, that's of course also a simple thing. So here, if you're interested in the code, here's the short link, bit.ly, SPM, you saw Python meetup, _ do it yourself, DIY, and the slide deck you see the whole time in the browser. So first case study, financial data APIs. So just a little bit of a disclaimer up front. There are several data sources out there which are completely free. When I started writing books and teaching, etc., I was also going with these free data sources, but there have been so many issues over the years, right? Like Yahoo Finance stopping the service and here and there, that I these days usually don't recommend the free sources anymore. This is also, yeah, I would say, the reason with regard to data quality, etc. There is one new player in our world, which is called end-of-day historical data. We don't have any commercial relationship, but I think for everybody, when I was starting, I would have loved to have something like this available. And they offer, I would say, what I can say, like the most comprehensive data sets and with the best service in terms of like 100,000 API calls per day, etc., for pretty low prices. Which means if you go on that and have a look, so I'm not advertising that, but for people who are interested in that. That's, I would say, almost amazing when you compare that to the Bloomberg terminals. The Bloomberg terminal, for example, costs some 2,500 per month, right? That's a different game than this all-in-one package, which most people probably won't need ever, right? So it's like with 20 euros per month, you get professional data in a professional way. And that's for many other areas also not the case, right? So just like to have one a look at what it might cost if you, and I want to dive into it right now, if you want to retrieve data. So for what I'm going to show now, I need my credentials, so I have an account with them, but you can sign up for a free trial there as well. I said matplotlib is enough. I'm using here also plotly and cufflinks. For example, setting up the connection, and for most people, I think stock investing is of interest, or maybe buying ETFs or funds, but stocks, I mean, everybody can relate to Apple, Amazon, whoever, Tesla maybe. And when you want to retrieve your data, for example, for Apple, that's as simple as that. It might take a while, also depends on the speed of the internet or the traffic on the API. They don't have, I must confess, the most convenient Python implementation. So you see here they deliver like a dictionary. This should be, I would say, a data frame in the first place, right? There shouldn't be any need to transform it, but still it's just like one line of code more and you get your historical Apple data here. I'm just picking out the adjusted close price in the last 1,000 data points, and this can be now done for thousands of stocks in the US, in Europe, they have even exotic places. I would show you the exchanges just to get a feel for what you could expect from a professional API there, right? For most people, and what I've picked out here, these are all ETFs that I have personally invested in as well. So this was just like personally driven. Here is the MSCI World, there's iShares Information Technology, NASDAQ, and a little bit of gold here, right? And you can get prices for the ETFs as well if you want to, for example, form a portfolio of ETFs which are cost effective and easy to trade, right? And you can trade them basically for free, you can say, even with the German brokers. So they are really good means to build a long-term portfolio if you want to do it on your own and don't want to pay anybody else for anything in this context, right? You can then, for example, put them together. Again, this is more meant for you to play around if you want to change something here or want to sign up for a free trial that you can maybe retrieve data that is more of interest to you. Here I do a normalized plot of these 4 ETFs. And speaking of investing, these are quite highly correlated. You can see it, right? These two are going in parallel. And of course, pandas and the NumPy world, they help us with calculating correlation factors, for example. And if you want to come up with a well-diversified portfolio, and even if you don't have studied finance, I think this should be clear here that if everything is more or less fully correlated, it will be difficult to get a diversified portfolio. Because if everything goes in the same direction, how do you want to get any kind of diversification? But these are just examples. And the next ones are now almost exotic from an individual investor's point of view, but for the professionals, of course not. When we think in terms of corporate bonds, you get the data there as well, right? Something that you hardly ever get from any other like free data source like Yahoo Finance or government bonds even. So say you want to maybe invest in the German Bund these days when the yields have become a little bit better, right? But I would say I've never invested a single dime in a bond there. The exchanges, I said, even if you go beyond the US, let's say the UK, you see here they have stocks data and other data for almost 60 exchanges there. So just to get a feel for like what it means to work with a bit more of a professional API. Then fundamentals data might be of interest, doesn't have to be. What I'm getting asked quite often, mostly from people from India, I would say, is how can I get free options data? There is no free options data, is my typical answer. But here for very low fees or relatively low fees, you can get your options data as well. So just like to say, more or less the data availability has been democratized, I would say. Because this, let's say, for university context or for research context, investing €80 per month is not really, I would say, a high budget when you compare that to the compute or whatever is used on the other side, right? Data is there, as much data basically, or even more that you would like to have probably, right? In the end, the question is now what you do with the data. And there is this mean variance portfolio theory. Who has ever heard of that? Mean variance portfolio theory? Just one? Just one? Again, this dates back to 1952, and Harry Markowitz was later awarded the Nobel Prize in Economics, which is not really the Nobel Prize, but something similar, right? Because it was like when quantitative investing really started. Before that, it was more like, oh, I like that stock, right? It's a good management. Oh, they have good products, right? And he was the first one basically to formalize that and to say, well, let's concentrate on risk and return and correlation. His basic insight was that if I put a bunch of stocks together, this in and of itself, if there is no perfect correlation, this correlation is not equal to 1 or not equal to -1, then we will see some diversification, meaning we can reduce risk by putting more stocks into a portfolio. And he formalized this idea, right? So what we now, and I have changed here the data source, so for everybody who wants to try it, but don't want to sign up for the trial account, for example, that I've shown before. This is just a static data file, which has 10 years worth of data for a bunch of names like Apple, Microsoft, Intel, Amazon, blah, blah, blah. It goes down here also to Bitcoin, for example. Who is doing something with crypto? Bought some crypto? Not that many, not that many. I'm surprised, actually. Usually in these groups, there are more in crypto. I've included in my example now, in order to give you a feeling for like what it means to use this approach. Apple, we all know that. SPY, that's the S&P 500, the 500 constituents index of the US. Then gold and BTC. This is more or less arbitrary, but it should show something like stocks, a broad index, commodities, and crypto. Right? This could be some classes that you might want to invest in. And I retrieve the data or pick out the data from my static data frame that is now in memory, calculate the returns, and here you see now the returns distribution. This is basically what we work with. We don't work with a time series, with the price data that we have seen before. It's just the returns, like +1%, -1%. We all know prices go up and down. That's the very nature, right? We hopefully get somehow paid for the risk that we take in this context. So the expected returns, when we look at them, here the data is of course on a daily basis, but for everybody, also for people in finance, or long in finance, annualized values are much more meaningful, right? Apple, over the period that we consider, has had a positive performance of 26%, and these are log returns, not yet in the real returns, but we can compare them easily. At the same time, the S&P 500 just 11%, gold, that's just like 4.4%, and Bitcoin, over these 10 years that we cover, 56.3%, the best performing one, right? Just to emphasize this here, this is going from beginning of April 2012 to this year, end of March. So this is the 10-year period. So it has the recent downturn of Bitcoin included, but still, average here 56 in log returns. What about the risk? Now is the other side, the volatility, right? Apple, higher return than SPY, but you also see higher risk. This is what I meant before. Usually when you see a higher return for something, you would expect it to have a higher risk as well. So that's a standard, that's a fundamental relationship. SPY, yeah, lower risk. Gold, yeah, pretty low risk. And BTC, the daily volatility here, yeah, the highest, right? That's pretty high. So let's annualize that again. Much better to read. Annualized here 28%, but compare this to Bitcoin here at 73%. So the amazing 56% return, log return, come here at the cost, namely higher risk. So that's the basic thing that you find in finance all the time. And when you pick up a finance book, you find it basically on every second page. Many theories have this at the very core. The question now is, when we put these four together, what happens to the risk and return of the whole portfolio? Because this will be a different beast, right? I can put 80% in Bitcoin and only 20% the rest, or 10% in Apple and 80% in SPY and the rest in the other ones. So we now have a flexibility, and that's the core thing, what all the robo-advisors, etc. now do. You specify the universe, and then they come up with the allocation. So that's the data that we have. I go a little bit faster through that. So one basic idea would be to say, well, we do equally weighted portfolio. A quarter, we have 4 assets, 25% in every asset, right? Here we have the equal. This is just a different way of calculating that. The portfolio return of that would be 24.6%. The equally weighted portfolio would give us an expected return of almost 25%. Now we get to the portfolio risk, and the formula for the portfolio risk here, it's a little bit lengthy, so we need the covariance matrix annualized, right? And we have 2 dot products. So here's quite a bit of linear algebra, but people who are concerned with, let's say, neural networks, this is like kindergarten linear algebra, right? This is just like 2 dot products, nothing spectacular, and of course Python pandas, NumPy, they help us here. So the portfolio risk would be 22.89%. Here's the correlation. You see also here now some negative correlation and some other numbers. Now let's get to the mean variance portfolios. So now it's getting a bit more interesting, because I start with the equally weighted portfolio. We have now just one combination, one pair. 26% return, 22%, or what was it, 22.8% risk. What I'm now doing here is simply Monte Carlo simulation. And based on the Monte Carlo simulation, we now get what is called risk-return combinations, possible risk-return combinations. So we see every dot that we see here is a random composition of the portfolio. So we have portfolios which have pretty low risk, but they also have pretty low return, right? And here you see the relationship already. When I want to have more return, I need to incur more risk, right? I need to move to the right-hand side. I can get some 40% expectation, but then the risk already here is at 45%. So it's not like a linear line through that, but this will be a next step. These are just the portfolio or randomized portfolio compositions, and we see the resulting risk-return combinations out of that. We could basically now choose one of them. Some would say, well, I like here, right, and that one, I want to have that expected return, but the risk, yeah, of course, I'm willing to do that. Other people would say, no, I want to retire next year, so I want to get my portfolio a bit more safely constructed. The question is now, what are optimal portfolios? Because these are just random ones. There are now a few options, standard options. The one is the maximum Sharpe portfolio. So what is Sharpe? Really simple. Again, we have just risk and return. This is now a simple relationship where we have the portfolio return over the portfolio risk. Of course, the higher the risk, the worse for me. The higher the return, the better for me. A very simple relationship, but it's a very fundamental one in finance. So the Sharpe ratio here is 107 for the equally weighted one. With a little bit of optimization, when I say I want to maximize that, right? We get here the optimal portfolio, and the optimal portfolio for the maximum Sharpe, which is after maximization 1.17, the equally weighted one was 1.07. It now shows you that Apple should be 50%, gold, SPY none at all, gold 34%, and Bitcoin, maybe surprisingly, just 15%. So Bitcoin, for example, is part here, but it's not, well, let's say the major part, because how they call it, the Bitcoin maximalists, right? They put everything, they sell their house, their home, their cars, put it in Bitcoin, but this calculation, if this is the correct one or not, this needs to be decided, but this calculation says, well, maybe you shouldn't be the maximalist here in this context, you should be an optimizer. So the portfolio return is 23% and the risk is 20%. So it's slightly different, obviously, to the equally weighted one. Minimum risk portfolio now has no Apple whatsoever. Right, we see it here. Sorry, yeah, I can show it here. It shows it. Minimum risk says no Apple, 39% S&P 500, 60% gold. I think this does make sense, right? Minimum risk. For the minimum risk, it makes sense because gold is basically this unrisky, more or less unrisky asset. And Bitcoin, yeah, it has survived, but it's just like 0.1% here in this context. So the portfolio return is only 7.1% and the risk is 10.9. So getting back to my chart, this is something like here, right? So here, return and the risk maybe here. So we didn't hit it with the random one, something like this. This is minimum risk. I'm not saying that this is the best thing that you could do, right? It's just saying that this gives you, taking everything into consideration, the minimum risk. So this shows now with the two triangles your maximum Sharpe and your minimum risk. And this is typically what investors would like to have in such an investment context, the maximum Sharpe. You define your universe and then you say, well, putting return and risk into the relationship, exemplified by Sharpe, what is the optimum? And you see with Python, this is just like a few lines of code, a little bit of SciPy optimize that you use there, the minimize function from this sub package, and you are good to go. Same holds true here. Was that somehow clear too fast? So I didn't want to go into the details. I just want to tell the story a bit more, right, about that. But I think it somehow makes sense, right? Once we have in the back of our heads this risk-return thing, I think the results make sense. What I try to be a bit faster. I started later, so what I'm now going to show is something that I don't know. When I gave a talk this April at Texas University in San Jose, so I was visiting Austin. They invited me. I thought it would be interesting to include that. And my final talk where I had this included was more or less, I think 2/3 were faculty members, so professors and PhD students, etc. Right? I said, and finance department, not like General was finance, was invited by the finance and econ department. Well, economics and finance. And I asked, do you teach here? Do you know about risk allocation and risk parity? And almost everybody said no. We're like 2 hands only from like 60 people or what. And I was a bit surprised because this is something that has become so popular in the practical world, and which is from a finance perspective, I think pretty intriguing. Maybe, I hope so, you get the idea of that here as well. Before, to recapitulate, we decided on like the distribution of our capital into the 4 assets, right? 50% in Apple of whatever. If it's €1,000, it's 500 euro. If it's a million, it's 500,000, right? This was the asset. This is what is called asset allocation. Now what we are going to do is to allocate risk, right? And I have some background, but I skipped that. I have background on the slide deck also with some references, right? But let's have a look at the numbers, and I find this is pretty interesting. So the covariance matrix here is the equally weighted portfolio. This is what we got started with, right? We have the volatility that we have calculated before, yeah, I'm going through a couple of things here that I don't want to highlight. It's marginal volatilities. I basically here in this part explain and just so that you have seen that. I have a bit of background here to the mean variance portfolio approach, right, which I skipped basically, portfolio statistics, and here this is, yeah, I think that's, at least to my knowledge, one of the best books on the topic, a big finance book. Here, this is what I'm now going through. Weights, risk measure, risk contribution, all that. This is a little bit technical, but from a mathematical point of view, it's more or less simple calculus, right? You see, you have partial derivatives and a couple of dot products here, but that's nothing really involved. There are other mathematical disciplines that are much more involved than that, right? So just that you have seen that, what I'm going through, so that you can maybe later on, if you're interested, go a bit more deeper into that. So having said that, it's already then my final part here. Coming to a risk parity portfolio. We start with an equally weighted portfolio, 25%, 25%, 25%, 25% in terms of capital, right? Now what we want to do is we want to do the same exercise with the risk of the single assets, right? So when I go with the equally weighted portfolio, and given the background that you have as of now, you see that with the equally weighted portfolio from Apple, we have a risk contribution of 17%, from the S&P of 10%. Gold, no surprise, has a very small risk contribution of 3%, and Bitcoin, given the numbers, has 70% risk contribution, although we are just having 25% allocated, right? So the maximalists, of course, when they say have everything in Bitcoin, it's a simple calculation. It's 100% risk contribution, right? But here with our 4 assets, I think that's now a pretty clear picture with regard to the riskiness of them. Capital equally distributed, but the risk contribution is different. So I use now a measure to get to do some optimization. And what is the optimization like? I now want to reallocate my funds in a way that we have an equal risk contribution. That we say we are not budgeting capital, we are budgeting risk, right? And that's I would say the major insight here and the major approach when I do the optimization. I have now the allocation here, right? And the relative contributions, when I calculate them now with the optimal allocations, you see they are now, apart from numerical rounding errors here, they are now 25%. How do I get to that? And that I invest 17% in Apple, 27% in the S&P, 46% in gold. Makes sense, right? Gold is not really risky, it's almost riskless. I need to put lots and lots of cash into gold so that I get like 25% risk contribution. And in an equal risk portfolio, I would only have 8% in Bitcoin. Again, a little bit against the maximalists. So the overall portfolio volatility would be 0.13. Now I was saying equal risk, but this might not be your favorite allocation. You might say, well, I have maybe some random allocation here. This is like getting some random allocation. I can redraw that, right? So this is just to say, well, this might be your favorite allocation, right? And you can then go and also derive the asset allocation to achieve your desired risk allocation in that sense. So, and that's something whenever you hear like, I don't know, on YouTube or in a, I don't know, CNBC interview, Bridgewater, for example, one of the biggest hedge funds in the world, they have become pretty popular and successful by using this particular approach. It's not, I would say, fail-proof, right? Nothing in finance is, but it is a pretty, from my point of view, appealing approach to say, well, what I invest in, of course, is an important thing, but what is the risk contribution given my overall portfolio when I invest X, Y, that % into these? You can then go one step further, just like as a final thing, when you say, well, I can also have a target volatility of 15%, but this is now pretty technical in that sense. So to sum it up, a little bit over time. We have like these two fundamental ideas. This is from the 50s. This came much later in the 90s. You can say, well, let's say you have 10,000 that you want to invest. You can then say, well, these are the assets that I want to invest in. Maybe you have a look around at with the data API and you play around. Then you can say, in the first case, you can say, well, I put 20%, 20%, 20, 20, 20, equally weighted into 5 different ETFs, let's say. Or you say that's the new approach. You say, well, I want to have like an equal risk contribution with regard to what I'm investing in, and then you go backwards and derive the asset allocation in this context. But you see, with these blueprints, you just replace, and everybody in here, I think, is able to do that. You can create your own little data file. This is just like having, where do we have it? No, on that side. I think I'm showing it in the beginning, right? This is nothing spectacular. This data, how is it called? This is raw, right? Raw head, let's say. So it's just like closing prices. It's time series data, and it has the constituents on the top end. And this can be easily replaced via the API that I've shown, via other data sources, and then you plug it in and you let it run, or you pick and choose your assets, your favorite assets, and you go through that. And that's like basically the way how wealth advisors, robo-advisors, etc. work, and they adjust this then, of course, when new data has come in. Let's say every quarter they adjust it, they update the portfolio, do the rebalancings, and that's what they charge you for, like 1, 2, 3% per year in this context, in the hope that you will make more even after they subtract their costs. Yeah, that was, of course, disclaimer. This is no investment advice, right? It's just like technical illustration. Thanks. Any questions or just drinks? Yeah, and the background, dark background.
Very interesting talk, thanks. So this was basically all on the stock data, right? So like the real numbers you get from the stock market.
Mm-hmm.
You also talked about news articles in the beginning.
Mm-hmm.
A very simple robo-advisor I would basically build is something like fetch all news about Apple and do a sentiment analysis, and then if you see like a change that it's getting more negative or something, you sell. If it gets more positive, you buy.
Mm-hmm. Yeah.
So this sounds super simple, right? I guess it's too simple to really make money with it. But what's your experience on such, simple approaches?
Yeah, of course. I mean, like almost everybody in the industry has tried and done something similar, right? This is, I would say, already standard part of all these predictive models, and also in terms of risk management, right? You have what we have been doing here, again, is not like to be done on a daily basis, right? You do it once, and maybe then every quarter you revisit it, or if there is some major change, macro change, and you want to revisit it, and you want to rebalance, update your portfolio. But in a risk management sense, for example, this could be an early warning indicator. You say, well, I'm like overweight on Apple, right? And I need to, not hedge my exposure, but I need to see when things change there considerably. What you could also think of is like that you go overweight, underweight certain stocks, let's say of the S&P 500 or the top 100, according to market capitalization based on positive and negative sentiment, right? More or less like a momentum strategy where you say, well, the ones are the one that are overweight, the other one underweight compared to the index, or you would even say I short the ones with negative sentiments, so sell them and I go long the ones with positive sentiment. But again, this is, I wouldn't expect too much alpha, as they call it, in this. So even people these days, they try to, of course, mine social media. It's a little bit faster even, right? When you have these Apple events, people are sitting there and tweeting and on Instagram and Facebook and whatever, right? But this is pretty noisy because you also have some, let's put it mildly, silly people doing stuff there, right? And easily run into a trap. What we have done indeed as a client project, this was for Dow Jones, and it was crypto related. We have built like a real-time sentiment generator for crypto, and more or less it wasn't intended for trading. It was for them intended to have like a showcase, right? So what can you do with the data and the real-time data that they provided? We did this real-time NLP sentiment analyzer where we had our sentiment numbers, and they were like shown then not relative, in the same chart, like in an overlay chart with the Bitcoin prices. And this looked, honestly, on a real-time basis back then, it's a couple of years back already, it looked pretty interesting, actually. So on a real-time basis, this might be informative. But again, if there is lots of alpha these days in that, because basically everybody fires up a couple of AWS instances, and yeah, therefore it's usually it's part already of the game. Let me put it that way. Yeah.
Are fundamentals of the stocks taken into consideration when like deciding the risk allocation or like doing the distribution of stocks? Like,
say it again. At the beginning, I did.
Are the fundamentals of the stock, like price to earnings and all these fundamentals taken into consideration while doing the risk allocation? Because maybe like during the COVID, Apple was quite volatile, so the variance increases quite a lot during that time. So is the fundamental taken into consideration, or is it's pure?
In nothing that I've shown any type of fundamental data has played a role. I'm not saying that it couldn't or shouldn't play a role. I was briefly going over that, right, when I showed the API. You get also, like, via the API, you get your fundamental data if you're interested in that, right?
Okay.
But we need to have, and this is a problem that you face in this context, we have different time periods, right? You have end-of-day data, at least for the prices, or even intraday data, right? And when you go to the fundamentals data, they change like every quarter, every month, every half a year, right? Every year, sometimes even only. So there's always like a little bit of this. You might include this, for example, now going into financial theory, when you have a model such as Black Litterman, where you are not working with your historical returns that you use as a projection for the future returns, where you include judgments, or what it's a views or hypotheses on the future returns, may be driven by the fundamentals. Yeah. Shut up, please. Siri.
Okay.
Sorry. So it can be included, but the approaches that I've shown here, the basic ones that I've shown, they don't have any notion, no idea whatsoever with regard to fundamental data, because that's like maybe the strength, or I would say probably also the weakness at the same time, because they focus just on these two moments, right? The first and second moment of the distribution of the returns. Right. There's nothing, for example, like with regard to fat tails or high peaks or whatnot, and it's easy to show, and none of the data I've used is like normally distributed with regard to the returns, but nevertheless the theory implicitly or explicitly assumes that only the first and second moment are relevant here from a statistical point of view. So no fundamentals whatsoever. But even on the statistical side, I would say we are like assuming away stuff that might be important for such a decision. Right? Late enough on the jump. All right, there may be some drinks more, and hope to see you soon back for the next meetup.